From a young age, Edward Thorpe possessed an uncanny ability. Numbers weren't just figures to him, they were a language he understood instinctively. Growing up in a modest household, he devoured books on mathematics, teaching himself advanced concepts. His playground wasn't swings and slides, but the world of numbers, equations, and probabilities. As a teenager, Edward discovered a way to apply his unique skill set, the bright lights and thrilling games of the casino. Blackjack, with its blend of chance and strategy, became his initial proving ground. Edward saw beyond the luck, recognizing the mathematical underpinnings that governed the game. He immersed himself in probability theory, mastering the art of card counting and developing his own systems to gain an edge. The casino, once a place of amusement, transformed into a real-life laboratory where he could test his theories and refine his skills. Word of his winnings spread, attracting both curious gamblers and wary casino security. Edward, however, wasn't motivated by fortune or fame. He sought the intellectual challenge, the thrill of pitting his mind against the house and emerging victorious. His success in casinos was merely a stepping stone, a testament to the power of disciplined learning and strategic thinking. It was in the world of finance, however, where his mathematical prowess would truly flourish. Edward understood that both gambling and investing involved inherent risks. The key to success lay not in eliminating risk, but in understanding and managing it. This is where his mastery of probability and statistics came into play. Probability, he knew, was about understanding the likelihood of specific events occurring. In blackjack, it was the chance of drawing a certain card or the dealer busting. In investing, it was the potential for a stock to rise or fall based on market conditions. Statistics, on the other hand, helped him analyze past data to identify trends and patterns. He devoured historical stock charts, studying market cycles and economic indicators to make informed predictions about future performance. Edward firmly believed that while luck played a role in the short term, long-term success stemmed from calculated risks backed by solid understanding of probability and statistics. He saw the stock market not as a casino, but as a complex system governed by quantifiable factors. He knew that by diligently analyzing data and applying statistical models, he could significantly improve his odds of making profitable investments. This disciplined, data-driven approach set him apart from emotional traders swayed by market noise and speculation. For Edward, knowledge was power, and he was relentless in his pursuit of both. Blackjack, unlike other casino games, offered players a fighting chance. The element of skill, however small, intrigued Edward. He delved into the intricacies of the game, mastering basic strategy charts that dictated the optimal move for every possible hand. Yet he knew that to truly gain an edge, he needed more than just basic strategy. He needed card counting. Card counting, he learned, wasn't about memorizing every card dealt. It was about keeping track of the ratio of high cards to low cards remaining in the deck. A higher concentration of high cards benefited the player, increasing the likelihood of getting a natural blackjack or the dealer busting. Edward became proficient in the high-low system, a simple yet effective method of card counting. He assigned a value to each card, +1 for low cards, 2 to 6, 0 for middle cards, 7 to 9, and -1 for high cards, 10 to ace. As cards were dealt, he would keep a running count in his head, adjusting his bets based on the count and the remaining cards in the shoe. This system, while not illegal, was frowned upon by casinos, and Edward had to develop strategies to avoid detection, blending in with other players and masking his betting patterns. His success in blackjack wasn't about luck, it was a testament to his dedication, discipline, and ability to exploit the subtle mathematical edges that the game offered. This experience would prove invaluable as he transitioned to the world of finance, where similar principles of calculated risk and strategic decision-making applied. Section 4, From Greenfelt to Wall Street, a new game, a new challenge. Leaving the casino world behind, Alex set his sights on a new challenge, Wall Street. The stock market, with its intricate web of interconnected companies, industries, and global economies, presented a far more complex puzzle than any casino game. However, the fundamental principles remained the same: risk assessment, probability, and the pursuit of profitable opportunities. Edward quickly realized that many Wall Street players relied more on gut feeling and speculation than on sound mathematical analysis. He saw through the jargon and buzzwords, recognizing that behind the complex financial instruments and trading strategies lay the same fundamental principles of mathematics that govern the casino floor. He began by applying his statistical modeling skills to analyze historical stock market data, identifying patterns and trends that could be exploited for profit. He dove into financial statements, learning to dissect balance sheets and income statements to evaluate the true worth of companies. His time in casinos had taught him to think probabilistically, to anticipate potential outcomes and manage risk accordingly. He understood that the market, like a deck of cards, was inherently unpredictable in the short term. However, over the long term, patterns emerged, and those who could identify and exploit those patterns held a distinct advantage. Section 5, the Index Fund Revolution, embracing the wisdom of the market. As Edward delved deeper into the world of investing, he encountered a concept that resonated with his data-driven approach: index funds. Unlike actively managed funds that relied on the often flawed judgment of stock pickers, index funds simply tracked a specific market index, such as the S&P 500. The idea was simple yet powerful. By passively mirroring the performance of the market as a whole, investors could achieve returns that consistently outperformed the majority of active fund managers over the long term. This resonated deeply with Edward's understanding of probability and market efficiency. He knew that trying to consistently beat the market was a loser's game, fraught with fees and emotional biases. Indexing, on the other hand, offered a low-cost, diversified approach that aligned with his long-term investment philosophy. He recognized that while individual stocks might fluctuate wildly, the market as a whole tended to trend upwards over time. By investing in a broad basket of stocks through an index fund, he could capture this overall market growth without the stress and guesswork of individual stock picking. This approach, while seemingly simple, was a radical departure from the prevailing wisdom of Wall Street, which often touted the expertise of individual fund managers. Edward, however, trusted the data, and the data clearly showed that in the long run, low-cost index funds were the most reliable way to build wealth. Section 6, Beyond the Numbers, Emotional Discipline and the Long Game. While Edward excelled at the analytical aspects of investing, he understood that success in the market required more than just crunching numbers. He observed that many investors, even those with strong analytical skills, often fell prey to their emotions. Fear and greed could cloud judgment, leading to impulsive decisions that often proved detrimental to their portfolios. Edward knew that mastering his emotions was just as crucial as mastering his mathematical models. He developed a set of rules and principles to guide his investment decisions, removing impulsive emotions from the equation. He learned to control his fear during market downturns, recognizing that dips in the market were inevitable but also presented buying opportunities. He resisted the temptation to chase short-term gains, understanding that true wealth was built slowly and steadily over time. He never allowed greed to dictate his actions, sticking to his predetermined risk tolerance and investment strategy. This disciplined approach allowed him to weather market volatility and capitalize on opportunities that others, blinded by emotion, might miss. Edward understood that investing was a marathon, not a sprint, and that patience and discipline were essential for long-term success. His journey from the casino to Wall Street was a testament to this philosophy. Section 7, The Power of Mentorship, Seeking Guidance on the Road to Success. Despite his independent spirit and self-taught expertise, Edward recognized the value of seeking guidance from those who'd walked the path before him. He sought out seasoned investors and financial experts, not to blindly follow their advice, but to learn from their experiences and gain different perspectives. He understood that even the most brilliant minds could benefit from the wisdom and insight of others. Mentorship, he found, wasn't about receiving ready-made answers, but about engaging in thought-provoking discussions, challenging assumptions, and refining his own investment philosophy. He learned from the successes and, more importantly, the mistakes of others, gaining valuable lessons that no textbook could teach. One of his mentors, a retired hedge fund manager, emphasized the importance of humility in investing. The market, he learned, was a humbling force, and no one, no matter how brilliant, could predict its every move. This lesson resonated deeply with Alex, reminding him to stay grounded and always approach the market with a healthy dose of respect for its inherent unpredictability. Mentorship, he realized, was a two-way street. By sharing his unique perspective and analytical skills, he could also contribute to the learning process, creating a symbiotic relationship of growth and discovery.